All right, welcome back. We talked about new bullish news in the last segment, right? My next guest has got some pretty strong thoughts on that topic. He says any dips that happen due to the uncertainty of this bill in D.C., well, it's now passed. They should be aggressively bought now. It's got to go back down to the House, and we're still going to be talking about it. But it's going to be something that's been good for the market, and the market's reacted so far today about it getting through the Senate. So that's one decent thing, right? Our next guest also adds that Powell's getting a lot of pressure to cut interest rates, and he may now cut in July. And July 15th is the day that we get another inflation report. So that could be a bullish surprise for the markets if that happens. He also adds, tongue-in-cheek, that if you're short this market, you need to get your head examined, right? But he may be actually right. There are reports of up to $7 trillion of money on the sidelines waiting to get in this market. Now, I actually think that cash is starting to be deployed now. These dips have been fairly well supported. So instead of giving away all the secrets, let's get him on to hear it straight from the horse's mouth. Please welcome to the show, Mr. Eddie Ghabour. Eddie, thanks for coming on. I'll just lay it out. One more thing on top of that monologue is that, 2 rate cuts maybe in the market. Big, beautiful bill finally getting through. It's in the market, I think. The trade deals in the market. My only concern was, and I brought this up yesterday, was a lot of this bullish news is in the market. And when that happens, sometimes when those things do come to fruition, we don't really rally on the back of it, right? What would be the next thing to come in the market? And I've been told that time and time again from people a lot smarter than I am, it's the money on the sidelines from those guys that sold into the April 8th lows that haven't gotten back in. What say you?
What's interesting about this market dynamic, which is why I continue to say it's the most hated bull rally of my career, is sentiment is getting worse and worse from a positioning standpoint as we continue to make new highs where people are still continuing to doubt this rally. And the flows, which you have to follow closely, they're going to have to capitulate and buy this market. And this is why we're saying, in the summer, especially August, it can generally be a very choppy month, and September as well, too. Buy the summer chop if you have not participated in this. And I think that dynamic is going to put a floor on how low these dips go. Because, again, these next 6 to 8 months can be extremely profitable. It's very rare to see a Goldilocks setup the way that we have, because even though this bill is going to pass, I don't think people have priced in how much liquidity this bill is going to put into the marketplace. And so this market, in my opinion, markets can get overbought for an extended period of time. And I think that's the type of market we're going to be in.
I think what the bill really brings to the table, if and when it's going to it'll get passed. But what it brings is surety for the CEOs. I mean, there's some money that's going to get unleashed in there too, but everybody has an idea about what's going to happen with taxes, and it's going to give everybody pretty much a playbook for the rest of the year, and then maybe even going forward. So that's going to be bullish. I agree with you there. But I also like what you just said about buy the summer chop. I think that should be the headline of your research, because that's a great way to put it up. Because I agree with you when it's just the psychological issue of we're not seeing face-ripping rallies. We did from the lows of April 8th, right? But now we're going to tack on 1%, 0.5%. And it's just going to be torture for the folks that sold into those April 8th lows to sit there and watch that happen. At some point in time, they're going to capitulate and they're going to come for the market. And I think it's going to be more towards, end of third, beginning of fourth, or when they really have to start playing catch up. And I think that's what we can see light the market on fire. Am I wrong there?
Not at all. And that's where you'll see that kind of blow off top that'll probably last into the later part of 2026. And that's why you're probably not going to see like a typical 10% correction you see, because so much money's on the sideline. A 3% drop is going to feel like a 10% drop. So that's going to have money flow into the market. So it's a perfect storm for folks like us that are nearly fully invested, because you just have to be nimble and tactical. And I'll tell you today, what's very interesting and sticking out to us is we're seeing small caps rip today. And that's a sign of confidence in regards to deregulation, as well as what the future is going to hold. Because we know 2 things. We know Powell is probably going to cut 1 or 2 times this year. And whoever President Trump puts in going into 2026 is definitely going to be cutting rates.
Right.
So you're going to see this dynamic where you have dollar down, rates down in a non-recessionary environment. And it's hard not to buy that.
I don't know if you saw this or not, but doing this show, I get to talk to a lot of smart people like you. And some of them manage big funds, and some of them, just manage people's retirement, education, and health accounts, right? Just, on an individual basis. And I'll say that through that March, April, May timeframe, most of them said to me, I kept asking the guys that manage the individual accounts, have you seen capitulation? Have they called up saying, no, and it actually was the opposite. Retail was the buyer. I don't know if you saw this as well, but the sellers were the investment banks, the hedge funds. Those are the guys that got scared out. I mean, you could see it on other stations about what they were watching and looking at, and those are the people that are going to have to get back in this market. I think they are a little bit. They're nibbling around the edges right now, but it was retail that really bore the brunt of the sell-off and bought it, and they're the ones that are really getting the gains now.
Look, retail, which was not considered the smart money, has proven that they've actually been the smart money. And I think the reason why is they don't overthink it. They see these big drops. I mean, you get a VIX in a 60, that is not a sell sign. That's a buy sign, right?
Right.
And that's what we saw. And the large money was scared out of it, or whether their algorithms didn't kick in, but they also have the largest sums of money. So that money has yet to come in. And most of those institutions are still net short the S&P, which blows my mind.
How are they net short the S&P? I mean, I can't imagine.
What we do know is they're going to have to capitulate, and they are the ones that have the bigger dollars. And they'll probably capitulate later because they're going to sit here and wait for this big drop that they probably will not see until they're forced to buy. Because when you go into the fourth quarter of this year, if you're not getting the rates of return anywhere near where the market is, then they're going to have to worry about job security. And we know they're going to have to window dress and be forced to buy.
I mean, sometimes you can be just too smart for your own good. Sometimes it's not as difficult as you want to make it be. And I think the retail was the one. For the first time in my career, I've been doing this for 38 and a bit years. I haven't seen the retail come to the, step up like that. And I asked the question, I don't know how many times, have you seen any capitulation? Because a lot of times you won't see the market bottom until you see that capitulation. And I kept on asking the question because I was looking for the market bottom. But no, it was the retail that really kind of stepped up. So I think that's really, really interesting across the board. And so we'll see if these investment funds, the smart money out there, the hedge funds, if they're going to have to come back. And I think you're exactly right there. And I'm glad to hear that you think it's not just going to be a 2025 thing, it's a 2026 thing.
Yeah, because again, when you look at the framework of what we're going to go through, we've gotten through the worst of it, the tariff scares, this bill going to pass, trade deals. That's all going to be behind us when we go into September and October. And then 2026, that monetary policy is going to get looser, not tighter. Government spending is going to be increasing, not decreasing. And you have that with the wage growth that we're seeing. It is a bazooka of liquidity that's going to hit this marketplace. And liquidity is what causes asset prices to really accelerate to the upside. And this is why we think we will continue to see that the risk is to the upside in this market over the next 12 months, not to the downside.
Love hearing it. We should have you on every single day. This is fantastic.